Paul Dietrich, CEO, CIO of Fairfax Global Markets with over 200 million AUM, joins us from New York. Paul, good evening to you. So low volume sort of markets that are ticking up. We're getting record after record after record, but on low volume. I don't know. Sounds like you should have an escape hatch or some sort of a strategy, at least, in an environment like this.
What investors have to understand is that in the long term, the stock market follows the underlying economics of the underlying economy. At Fairfax Global Markets, every quarter, we do a recession analysis, and we look at every single indicator that the U.S. government looks at to determine whether we're going into a recession or not. And if you look at every one of those indicators, they're all going up. They're all expanding. I mean, GDP, wages are going up, employment's going up, housing, manufacturing is going up, inflation is going down. The only thing that's been bad has been earnings over the last 5 quarters. They've been down, but largely that's because of energy and oil prices, and everybody knows that's really low energy prices has been a net benefit to the U.S. consumers. So if you look at all of the indicators, we're expanding. I think we need to get rid of the icons of the bulls and the bears, and we have to start thinking of this market like an elephant economy. You know, it's slow, it's plodding, it's consistent, it's mediocre, but it is going forward. But the question, though, Paul, that people want to know is how forward is it going to go, and is it inevitable that once it hits its limit, once it stretches the rubber band beyond max capacity, does this market have to fall? I mean, does it have to tumble? Does it have to correct 20, 30, 50%, or can it just maintain its current levels? I mean, history has shown that, you know, investors tend to operate in extremes. Well, you know, what is that limit? That's the question. And we've had in the past bull markets that have lasted for 10 years. You know, we saw that in the 1980s where it was 9-point-something years. So we could go a long way. Usually, historically, what causes recessions and bear markets have been bubbles. You had the dot-com bubble in 2000. You had the mortgage-backed bubble in 2008 and 2009. You had the savings and loan crisis in the 90s. You had in the late 70s, early 80s, the inflation. So we always have a bubble. I don't see where those bubbles are in this economy, and it may be one of the benefits of having one of the slowest recoveries of an economic recovery after a recession since the Great Depression, is that we really don't have any bubbles. And I think because of that and because of the slow, mediocre growth, we could see a 10-year bull market without anything. Now, will the stock market, you know, pull back some point? Yes, you know, it does that all the time. And that's kind of natural. But the long-term trend will follow the markets, and the markets, the underlying fundamentals of the markets are expanding and going up. And it's not just the U.S. We're seeing this expansion in emerging markets and in other developed markets. You know, J.P. Morgan just came out and said services in 30 countries were all going up. The manufacturing PMI index in countries is at a 9-month high. We saw China's manufacturing index go into expansion territory this month, and in Germany, you know, it's in expansion territory. So obviously Brexit hasn't had any effect. So it's not just the United States. We're seeing global growth right now.
Right. Paul, is there a place in the stock market for bond investors? You know, but one of the reasons that the market's doing so well is because the alternatives in fixed income are so very, very limited. Can people still nail down a decent sort of income stream in the stock market? Do you still have your undervalued large caps offering 3.5, say 4%? Because if they're going after income and not going after the next biggest, best idea since sliced bread, that would be a more sustainable approach to the market.
Yeah, well, in our firm, we're value investors. We look for undervalued companies with lower than average PEs, high returns on equity, high free cash flow. And one of the companies that I'm investing in right now is Verizon. Verizon's one of the largest telecom companies in the world. It's got a 4.2% dividend yield. It's producing massive cash flow. It's cheap at 13 forward PE, you know, what more do you want?
What more do you want? I'm at a loss for words, Paul, like you are there too. Yeah, exactly. That's it. Ditto. Put the order in and get it over with. Dinner time. Paul, always good catching up.
Yeah. Thanks.
Thanks, Paul. It's okay. We got to keep that thought. We always continue the convo.